Welcome, everybody. This is Marc Jimenez, Wealth Advisor and Chief Investment Officer for CAM Investor Solutions. I appreciate you taking the time to join us today. We have a special guest today with us. We have Sarah Ehrhardt with Michael Best. She's an estate planning attorney and the co-managing partner for their local Denver office, but they have offices around the country. And like that, Sarah also works with a lot of clients around the country. So I thought she'd be a great addition to have on today and join us because she sees a lot of different needs of clients, and she's been very helpful to not just our clients, but a lot of, I think, advisors around the country. And she's been a tremendous resource for our firm. So I wanted to ask her a few questions as it relates to estate planning, tax planning, but even the current environment. So welcome, Sarah, and thanks for joining.
Thanks for having me.
Absolutely. Sarah, you and I have been working together for several years now. You've some of our clients, you've helped them in different ways, but the last 3 or 4 months has been something that I think none of us have ever seen, at least in this country. And there's a lot of questions I know you've been receiving, we've been receiving about COVID-19, and none of us are health experts. But before we dive into some of the current environment, I wanted to take a step back because at the beginning of the year, there was a lot of changes that happened that had a significant impact on all things planning. As you know, we're big planners here at the firm, but in terms of estate and tax planning in particular, the Secure Act was enacted. And I think, I wanted to ask you, just because I think it's important that folks don't lose sight of what happened back in January, what were some of the biggest changes to estate planning as a result of the Secure Act?
Yeah, so I fully agree with you. It was signed into effect mid-December and was effective as of January 1st. And then COVID quickly came, and I think the Secure Act has been lost a little bit with the CARES Act and all the other things that have sprung up since then. But there are potentially huge estate planning implications, and one big piece is the Secure Act touched on IRAs, retirement plans, and shortened the time span to 10 years, the period within which certain beneficiaries would have to withdraw their IRA, their retirement plan balance after the death of an account owner. And prior law let most beneficiaries, and on the estate planning side, a lot of properly structured trusts, could withdraw the account balance in installments over that designated beneficiary's lifespan. And after January 1st, that is not the case. We still have a few exceptions. Surviving spouses, minor children, disabled and chronically ill individuals can still get that span, that stretch when they inherit an IRA or other retirement account. But most individuals can't use their life expectancy anymore to determine that distribution. So they have to take it out either in installments over the 10-year span, or they can do lump sums, year 2, year 5, right? Year 10 just has to be taken out within 10 years. And so on the estate planning side, 2 implications. One, trusts that might have been named as beneficiaries. The reason why you name the trust as the beneficiary of the retirement account for your children, for other individuals, other family members, it may not work anymore because of the changes that came about under the Secure Act. So you want to talk, if you have a trust who's named as a beneficiary, you do want to talk to your estate planning attorney and make sure the purpose behind it still works. And that goes to, you also want to review your beneficiary designations and make sure they still make sense. The second part is that acceleration of the income tax that's going to have to be paid. And so in the past, again, beneficiaries could spread out over their lifetime and they'd be paying the tax over their lifetime. With this squashing kind of to 10 years, you're accelerating the time frame within which beneficiaries are going to have to pay that tax. And so look at beneficiary designations. If you named a trust, talk to your advisors about, does that make sense? Does it even work anymore? The other pieces we've pointed out tied in with this change have been potential other considerations or how to use the retirement account or the IRA. Some, if you're naming charities as a beneficiary, potentially name now the charity as a beneficiary of the IRA or the retirement account, and name whoever else you're naming as recipients of other assets. Another option is Roth IRAs, those, doing a Roth conversion. That's been talked about before, but it can make more sense now when we have this reduced time period for beneficiaries to take out their proceeds.
Yeah, that's the last part's interesting. Well, all of it's interesting, but I think that last part in particular, because there's been so much discussion about the timing of these strategies that maybe should be considered, or how fast or when they should be done. Like with Roth, for example, is there an urgency perhaps to accelerate that strategy, just to use that as one example?
Yeah, I think, again, what we've done is you want to run the calculation, so it's nice to have maybe turning to you or a CPA who might be involved in saying what the tax implications might be. But oftentimes the individual who is the owner of the policy, it does make sense that they, depending on where they are in their career, in their age, it might make sense to accelerate that so that the beneficiaries who are inheriting don't have that lingering obligation. And you can do a bit more if you don't want a child to take everything out in a lump sum. If you're concerned about that, you can make sure that that income tax piece is taken care of with the Roth conversion, and then do some other planning to extend out or keep in trust what's left when you convert into the Roth. So yeah, it's good to look at, I think, for sure this year.
Yeah, that's a hot topic. I know, in light of a lot of things right now, obviously, especially the Secure Act. What one more question related to that is, what kind of time horizon, when you say looking at the projection with yourself, an advisor, a CPA, how long of a projection should someone look ahead when just, and I know it varies for everybody, but on average, how far ahead should they be considering when running some of these, considerations for Roth conversions, for change of beneficiaries? I mean, like 2 years, 5 years, 10 years, is there a kind of a optimal time frame?
So making those specific, if they decide to do a Roth conversion or looking at beneficiaries, so kind of now, because the changes have impacted enough that who you name as a beneficiary, it may have negative implications because of that Secure Act and those changes. The Roth conversion also makes sense now, or maybe in the next 2 years, and that goes to somewhat where we think the income tax rates might go, and I don't think many people anticipate them going down. That it's only going to go up, right? So if you're looking to do a Roth conversion, probably want to do it now or maybe next year, but you can't go on the assumption that income tax rates are going to be the same as they are right now.
Right. No, that's good. And I'll come back to that tax question in just a few minutes, because that's a bigger, I think, discussion for sure. One of the things I know we talk about, and you work with a lot of this audience, as do we, in terms of business owners, or I think even large families. But what are some of the best, in your opinion, estate planning opportunities for business owners and larger families with even larger net worth estates going forward?
Yeah, so I will look at kind of current 2020 situation, and we know we have depressed asset values, depressed business valuations. We also have very, very low interest rates, and so that combination of things leads to the use of some different types of estate planning techniques that you don't always see used when we have higher valuations and higher interest tax rates. A few of those that we've recommended, at least people take into account, kind of going from pretty simple to pretty complex, but it can work. Starting at the very simple, some individuals, if they do have children, maybe now who are running a business, or family members who are getting into real estate or buying up apartment buildings or other rental properties, and they don't have liquidity to potentially do what they're hoping to do. We've seen a lot of interfamily loans, knowing that third-party lenders have pretty low interest rates right now, but family members have even lower interest rates that they can charge. So the IRS releases the applicable federal rate, which is the interest rate, the minimum that can be assessed or charged when there is a loan. And in July, I went through and looked. It's kind of crazy. They're all close to zero. So that AFR that I referenced for July, if a family member entered into a loan with another family member, so that family member didn't have to go to a bank to get the loan. If that loan was to be repaid within 3 years, the interest rate is 0.18%, which is crazy. And beyond lower than 08, 09 rates. If that loan is in effect between family members for between 3 and 9 years, the current interest rate is 0.45%. And then if you want a loan, family members want a loan that lasts at least 9 years or more, it's 1.17%. So definitely something people are taking advantage of when with family members who might be doing different projects or see opportunities, and other family members have some liquidity and don't necessarily want to make a gift of it, but can do these loans, which is kind of a very friendly type of loan. The other types of techniques I'll see kind of in the middle, so that was kind of more straightforward loans, grant to retain annuity trust. So it's a type of trust, and estate planners like acronyms, so a GRAT. This type of trust, it's an irrevocable trust, and it's meant for the person who creates the trust, it's meant to allow them to transfer assets, whether it's potentially business interest or it's stock or it's real estate. They're transferring this asset into the trust without it being seen as a gift and without using lifetime gift tax exception. So the individual who's creating the trust receives back an annuity payment for a set term of years, and when that term of years ends, the asset that's in that trust then goes to whoever the beneficiaries might be named by that individual. And why you see GRATs as a common technique that's talked about today is that low interest rate again. As you're assuming whoever's creating the trust, you're putting that asset into that GRAT, and you're assuming that you're going to beat those really low, those interest rates I referenced. You're going to beat that interest rate. And so you're essentially getting more out of your potential estate into the hands of a beneficiary, but it's not seen as a gift that's cutting into your lifetime gifting amount. A third option, and I'm getting to like the more complex, are called intentionally defective grantor trusts or IDGETs. This type of trust, again, it's irrevocable. You often see it with family business owners, so it can be a way to transfer interest in the family business to children or to another individual, where you don't want to just make a whole gift of it. You want them to have a buy-in, or maybe you need some income stream coming back to you. You're not able to quite yet give a large amount of the family business. This IDGET, this type of trust, can be used to make a small gift, but then you're essentially selling the rest of your assets, so it's closely held business interest, to the trust, of which your child or children are beneficiaries, and the trust is giving you a loan payment back. And it all goes back to that tied in with the low interest rate. So you're not you're kind of giving a really good interest rate to the trust, to the beneficiaries, but you're also getting that asset out now with that depressed rate, that depressed value. And so the intention is hopefully it'll grow in that trust, and it'll grow outside of your estate. So there's estate tax planning there, but there's also that stream of income that's coming back to the individual, at least for the length of the loan. So those are the mix of not as complex to a little bit more complex ways to take advantage of the low interest rates and the low values that we have right now.
Yeah, those are. I mean, there are some of those are complex, I think, strategies, but some of them I think are simple too. And one I do hear or see sometimes business owners or families forget about or not think about necessarily are those interfamily loans, which, because again, I agree, we are at generational lows on interest rates, but also things like inflation. And now that's a different discussion, but because of that, it's important for all things, not just planning, investments, estate, insurance. I feel like there's opportunities that might exist here. So it's good to hear that you guys are looking at those things for your audience. In terms of, it's one thing when someone should review their estate plan and have it reviewed, but I think related to some of these more complicated strategies or more complex opportunities, How would someone identify that? When's a good time to have that, you know, strategy considered for somebody, or maybe their policy or their estate plan reviewed?
Yeah, this ties in somewhat with what that the income tax that we talked about, and we don't anticipate rates going down. We anticipate they probably will go up, and part of that's due to the economic stimulus programs that the government has put in place recently, and they're going to need funds coming from somewhere at some point, and tax is a way to get that. So with these techniques, we also see some potential changes on estate tax and gift tax, and how much you're able to gift or leave as an inheritance at death without having a tax imposed on it, and those amounts going down. And so some of the techniques I talked about can be very good to enter into now when we know what our tax situation is. But even if you don't do that, even over the next few years, as people are comfortable transferring business interest, that's a huge step. So even though there's some tax reasons why people may want to at least think about it this year or next year, no, I fully get there's other reasons behind timing of when someone will transfer their business interests. And so if it's not quite right yet, keep in the back of your mind, tax rates across the board for different items may change, and it may impact how well you can take advantage of those techniques.
Right. Yeah, and that kind of that's one of the questions I had, not just in terms of when, but in the current environment, looking at, we know there's an election coming, in November, both at the congressional level, a lot of fiscal decisions being made, presidential level. I mean, what else should clients be considering right now in light of that, whether it be a state, tax, anything related to what you do for your clients? What else should people be considering right now in light of potential impacts of the election? And again, there's no certainty yet, but there seems to be some things that are more likely than not to come out of this, like you highlighted a minute ago.
Yes, the income tax. Yes, you're right. So the presidential is big, but it is across the board. These elections are really important, and I think tax is one place that it's going to impact. So it ties in with COVID, with the economic stimulus programs, and with who's elected across the board. With the tax law changes that were done, I think back in 2017, on the estate planning side, so the estate and the gift tax and the generations giving transfer tax, those amounts were significantly increased for individuals, and they're set to sunset at the end of 2025. But with these upcoming elections, with what the economy and what we're going through currently, we don't think that we'll have until the end of potentially 2025 to have these really high amounts we can transfer during life and at death. And we anticipate, could be next year, could be in a few years before 2025, that those rates, estate tax, the gift tax, the generations giving transfer tax, the amount that you can transfer is going to fall from the estate tax, and the gift tax exemption is currently 11.58 million in 2020 for each individual. We don't, and it's indexed for inflation, so it'll go up again a little bit next year. So the thought is that is going to come down significantly. It could go down I don't have my glass ball, but like 5 million, 6 million. It's not expected to be that high. We know that 2020 we should be okay. And so if you're looking to do any planning this year, we're pretty, we feel confident, right, that those are the amounts we can play around with, 11.58 billion. Cannot promise that for 2021 or going forward. So I think the elections will have a big impact. By the time you get to the election, that's November, and we only have a short window of time.
Right.
If you're getting planning done before year end, that's hard to just wait until the election. So I think people have to think of what could change, and that is one that could change. Maybe it won't, with however the elections go, but it can be hard to wait until November to pull the trigger and use some of these estate planning techniques.
Yeah, that seems, we've been telling our clients for a lot of things, not necessarily the estate planning side, but other areas too, that, hey, don't wait, because if there's potential of any change that might impact you in any of these areas of all things playing, we'll call it, better to get in front of it rather than wait till the end, just to provide flexibility and opportunity. One other question I think on some of the current environment is we're hearing a lot of different ways, and this relates to state and tax too. What are some of the best charitable gifting strategies? We're seeing a lot of activity in that space, or a lot of desired ways to do that efficiently. What are you seeing with your clients?
So for sure, donor advised funds, I'm sure you'd agree, those are pretty commonly used vehicles. But charitable lead annuity trust is another estate planning technique, and it's just like the graph that I mentioned earlier. You're putting an asset into this trust, and the charity is the recipient, charitable lead, so they're getting an annuity stream paid back to them. So like the grant pays back an annuity stream to the individual who creates it. If you create a CLAT, a charitable lead trust, the charity is getting that stream of annuity payments for a term of years, and then at the end of the term of years, whatever's left in that trust, and again, hopefully it's grown, you can leave to any beneficiaries. So it's a way to give something to charity over time, not a big lump sum, and then also have recipients be family members and other individuals. So that's one technique, and again, that's fairly common right now. Ebbs and flows and how often that one's used. The CARES Act also put into place a few things that we talk to clients about. Some are smaller impacts. So one item in the CARES Act that states, so individuals who don't itemize deductions, so if they take that standard deduction, the $12,200 for individuals or joint filers, 24,400, if you take that standard deduction, the CARES Act has said you can still deduct up to $300, and again, it's small, but $300 of cash contributions made this year to qualifying charities. So it's an above the line deduction. Again, $300 does have to be made in cash, but it's an additional deduction that if you don't itemize, you typically couldn't even take into account because of those changes that were made in the tax law a few years ago. Two quick comments on that too. I've read that there are nonprofit advocates that are pushing for a little bit more than the 300, and you might see that in the next phase of the CARES Act potentially. And something I thought was interesting, that the Joint Committee on Taxation, when this came out, this $300 cash deduction, said that provision was expected to reduce or lower federal income tax revenues by $1.5 billion. So it's just a small amount per person, but it actually has a big dent on the revenue side. So my fun fact, right? I had to write that one down so I remember. One other piece of the CARES Act, the CARES Act raises the limits on the amount of cash charitable contributions that individuals and corporations can deduct, right, on their tax returns. So individuals, that's what I'll focus on. Individuals with the CARES Act change can now deduct up to 100% of qualified contributions, which is capped by the amount of their adjusted gross income. So before the change, it was 60% of your AGI. If you made a large contribution and you are itemizing, you could do a deduction of the 60%. Now it's 100%. The other benefit that they put in there is that if you make a charitable contribution that exceeds 100% of your AGI, that you can carry that forward. So that excess deduction can be used over the next 5 years. Two things I'll point out for that can be useful if you're looking to make a large contribution. There's some tax advantages. One is it does reference cash, so something like real estate would not qualify for that 100% raise threshold. And the second is that for whatever reason, donations to supporting organizations and donor advised funds don't qualify for that raise threshold. So there are some potentially useful ways that people are looking to make some charitable contributions, tax things that they should keep in mind, but then ways to give is like I referenced earlier with the trust or the donor advised fund.
Well, it sounds like, I mean, a lot of folks might be familiar with the donor advised funds or utilize those right already, but that's interesting to know that under this CARES Act provision, which I think, again, somewhere either the CARES Act got lost or the Secure Act got lost because there's been so much in the last 3 to 4 months. So that limitation that was there for individuals, potentially it's gone now, I think can be significant, it sounds like. And like you highlighted, the excess carryover for future years opportunity, that also, it sounds like it might be something that I'm pretty sure a lot of people don't know about and something they should know about. So thanks for sharing that. And again, like you highlighted also, I don't think we've seen the last of this version of the CARES Act. It sounds like they're already talking about was end of July or the next month or whenever year end, they're coming out with more options and more versions. So we'll have to keep our eyes on that and stay tuned for that. But I think what so far we know is significant for opportunities. Jumping in, I think related to that in the COVID-19, again, none of us are health experts. None of us can predict anything on how long, nor we try. But one thing we have been hearing a little bit about, and you've probably seen some of the same things in different states. We live in a popular state of Colorado, but other places, you've been hearing about clients or people thinking about relocating, either because of the job change that were impacted, or maybe because they decided that they have more flexibility now, or just want to be somewhere else. And so, are you experiencing some of the same things with any of your clients? Are you seeing some of that?
Yes, for sure. And I think for varied reasons. You alluded to that some are job changes. I think some employers are going remote or encouraging individuals who want to be remote to go remote. And so the impact, what I've seen with clients, in particular, I just focused on San Francisco, but I'm sure it's other places too. We have a few clients who are there who work for large employers, and they move there, they live in the city for that reason of going into their job to do that in-person appearance, and that's not going to be the case going forward, is what those employers have laid out. And so I am seeing those clients, the high cost of living there, of making the decision to move to Colorado, Arizona, Nevada, like they're moving to different places so they don't have to be in the city where they work anymore. And they want to have a better cost of living, right? And some are moving to where family is. So that allows them to kind of free them up to move and be closer to family, because travel is a little more difficult now. I think that's part of why people are relocating. But yeah, a lot of people are doing it. And then there's also some who are talking about it. And I anticipate more will pull the trigger and move when they feel a little more comfortable and finding home somewhere else.
Yeah, no, we've seen some of the same. So it's interesting to hear you're seeing that as well. One thing when folks, I think, relocate in any environment, whether it's proactively or in reaction to something else, there's always going to be things that they have to be aware of. They're pretty obvious. I think sometimes individual taxes might be one of those, because they know if they're going from, let's say, a higher cost state to a lower cost state. But I feel like one thing that is sometimes forgotten because it's not as obvious or isn't as well known is the estate tax or the estate planning implications of that. So talk to me maybe about some of the biggest estate planning considerations and estate tax considerations that if somebody is going to relocate or has relocated, what should they be thinking about?
So on the estate planning part, if they have done estate planning documents in the state where they were residing and they make the move, two kind of, one, you do want to check and have the documents reviewed by an estate planning attorney who's licensed in the state that you're moving to, just to make sure. Some states do have some really weird things in their specific state law that you might need to modify some of your estate planning for. Other states, you probably won't have to do much of anything, but it's good to know, just have someone do a quick check and make sure you're good. One item I'd point out is the health care power of attorney. So of all the different documents you might have in place, some of them aren't impacted as much. Healthcare power of attorney, state by state, it does vary. States are supposed to recognize other states' forms, but that is one I'd say doctors, physicians are most familiar seeing their specific state form. And so if you move to a different state, such an easy document to update. But that one I would recommend updating so that you are using the state form that hospitals, physicians in that state are used to seeing and reviewing. The other piece that kind of goes to the estate planning side is when you are making that relocation. If you haven't, I've had a few clients who didn't sell their property in their prior state right away. Maybe they're going back and forth, or they're planning to for a while because of jobs or other reasons, and eventually might sell that prior residence and fully move into the new property in the new state. But if there is some ties between the two states and you want to make it clear that you're a resident of the new state you're moving to, there's a lot of different like action things that you can take to prove your residency. I think that's more important to do, from my experience, in states that don't have an income tax, because a lot of people want to move there. Florida and Texas and Washington, and there's states that want to see that you're voting in that state, that you've changed your utilities, that you've registered your car there. Small thing, but you've changed your estate planning documents, that they don't reference your prior state, they reference your current state. So it kind of ties with estate planning. But if you are looking to change residencies, make sure you're taking kind of all these steps to make it look like you really are and want to reside in that new place. And the estate tax piece that you mentioned, so there's that federal estate tax that I talked about earlier, that 11.58 billion currently that you can pass free of estate tax. There are some states still that have a state estate tax on top of federal estate tax. And when I think of the West, the immediate comes to mind is Washington and Oregon. They do have state estate taxes. And not, I think it's probably the last thing people think of when they move to a state is, what if I die here? What are the tax consequences? But so it's not going to sway someone from moving to a state. But know that if you move to a state that has a state estate tax, there's potential tax implications there, of course, but there's different types of estate planning that you want to potentially think through in those particular states. And so if you do move to a state that has a state estate tax, then even kind of more the push to get in front of an estate planning attorney in that state, or who's licensed in that state, to help you see if or you need to kind of address how that state estate tax might work.
Yeah, that's a good point, because I think whether someone's going to one of those states, the Washington to Portland, or I know of several in the middle of all of this, current environment, folks have moved from Washington to Arizona, or Phoenix area, or Washington to Texas, not just for this perhaps income tax or other potential benefits, but there's other things that have happened there, and those are situations I think that would warrant some likely changes in various ways, just to use those examples. So that's a really good point. I said, one last question is just, I like to always think about things in a pretty positive manner, as you know. But Sarah, given everything that's going on right now, we're still slowly getting back to maybe the office or moving forward. But where are the opportunities for, clients like ours to really take advantage of estate planning ideas? I mean, some of that, you mentioned a lot of different ideas, which have been great, but really things that people can be doing right now. Just, they had to go out and have their estate plan reviewed, or something that maybe they need to do. What can they do to really make a difference now?
Yeah, a few things. So if they don't have an estate plan at all, this is kind of a good push, right? To go and do it. There's so many things that could change in the next year, in the next few years, that this is the time to start talking through those changes and how you can start planning for that. But it goes to people who put their plans into place years ago as well. This is, again, the time. There's enough changes there, not just of who you might be naming in your documents or who is a beneficiary, but enough changes in the state, federal, that it would be a wise idea to walk through what your plan is now and get recommendations from advisors like yourself, Marc, too, kind of thoughts of what they should focus on, and estate planning attorneys as well. We can give our feedback as what tweaks, what changes should be made. The other piece that I'd reference too, and it ties in somewhat with COVID and people going back to school, is estate planning for individuals, but if they have adult children, so over 18, those adult children should have, at a minimum, powers of attorney in place. So healthcare and financial powers of attorney, and not to be morbid, but they should always have them. When they turn 18, people should have those in place. without having a power of attorney, healthcare, financial in place, there is no default. A parent does not have the right to, or the ability to talk to a doctor if a child was hospitalized, unless there was a power of attorney in place. And the parent would otherwise have to go to court and get appointed as a guardian for that 18 plus child. So that's a piece that we're recommending people address, easy to address, very quick, but it covers situations that could potentially pop up. So kind of holistic family reviewing of estate planning.
That's actually a great, that's a great point to wrap up on, because a college aspect, beyond all the changes happening in college right now, I know in our education planning discussions with clients, we bring that up now because I know folks like yourself have said, hey, this is something that is being forgotten and lost or not thought about because it's never been maybe top of mind. And so that's a really good point, because that's something that I think a lot of folks we talk to don't have in place. And so definitely a good, important item to get addressed. But Sarah Ehrhardt, Michael Best, thank you so much for taking the time today. All the discussion's been great. I even learned a lot as usual when I speak with you and hearing you talk about these different topics. So I'm sure we'll have you back again as we get CARES Act version 2.0 or 3.0 or whatever comes out of this the rest of this year, next year, and we'll get an update then. So again, thanks a lot for the time, and have a great day.
Yeah, thank you.